Hello dear students, this is Financial Management Tutorial 8. The topic that is going to be discussed here is factors affecting the fixed capital requirement and factors affecting the working capital requirement. The learning objectives of this tutorial are to understand the factors affecting the requirement of fixed capital in a business firm and to understand the factors affecting the requirement of working capital for a business firm. Well, I hope the concept of fixed capital and working capital is pretty much clear to you. It was discussed in my previous tutorial. Here, just I am repeating in a single sentence. Fixed capital is that amount of capital which remain invested in the fixed assets or the long-term assets of a business. And working capital is invested in the short-term and current assets of a business firm. Now let's see the factors which affect the requirement of fixed capital in a business firm. Nature of business. In what business the firm is dealing that affect the requirement of fixed capital. Now, if the business is a trading business, that is, the business firm is associated with buying and selling activities, that is, say wholesaling activities or say retailing activities, then in comparison to manufacturing business, the requirement of fixed capital is low. The scale of operation is another factor which affects the requirement of fixed capital. If the scale of operation is very high, then automatically the requirement of fixed capital in the business firm also increases. The choice of technique affects the requirement of fixed capital. If the business firm is going to use more of capital intensive technique, or you can say more they are going to use technology and new things, innovative things, then in that time the requirement of fixed capital is high in comparison to those business firm who is using labor intensive technique. Then technological upgradation requirement in the business affect the requirement of fixed capital. If the rate of obsolescence in fixed assets of the business firm is high, then the requirement of fixed capital increases because they need to upgrade their technology very soon if the obsolescence rate is very high. The growth prospects of a business also affect the requirement of fixed capital. If there is much prospect or opportunities to expand their business in the coming days, then the requirement of fixed capital increases for a business firm. Similarly, if the business firm is going to diversify their business, diversify means they are going to add different lines of business in the existing business. So in that case, the requirement of fixed capital also increases because whatever the line of business they are going to aid, they are not related, they may not be related, and in that case the requirement of fixed capital increases. Then the financing alternatives available in the market also influence the requirement of fixed capital. Suppose the business firm is going to purchase their fixed asset instead of availing leasing facility, and that time they require more fixed capital since they are going to purchase that particular asset. The level of collaboration of a business firm reduces the level of investment in fixed assets, and the reason is that there may be possibilities that the firm with whom they are going to collaborate, the firm is bringing some technology, and that's why this firm they can proceed for collaboration without increasing the fixed capital investment. Okay, now here you see in the slide there is a cycle. You might have noticed And in that cycle there are a number of things. See, raw materials, work in progress, finished goods, debtors, bills receivables, and cash. Now all these are again related with the help of a arrow mark. A forward arrow is there, and that creates the cycle. Now this cycle, this is known as working capital cycle. Now all the things that you are noticing in this particular slide or in this graphic, the raw materials, work in progress, finished goods, stock, then debtors, bills receivable, cash, all these are current assets of a business. Now the current assets and including the liquid assets, these assets easily change its form. That is, normally within 1 year it changes form. Say the raw materials, if it is processed and in intermediate stage, in that time it is called work in progress. Again, if the work in progress it reaches the next stage of processing, then it leads to the finished goods. And if the finished goods are sold to some parties in credit, then debtors are created in the books of accounts. The debtors, when the time for the bill payment comes, that becomes bills receivable, and when the bill is paid or it is received, then it becomes cash. So in this way, one form to other form it changes, and it leads to bring cash or liquid assets to a business firm. Now this cash in hand and cash at bank, then marketable securities, this help the business firm to meet payment obligations towards the outsiders. And there is the concept of, there is a concept you have learned already in gross working capital and net working capital. The total current asset, a part of the current asset, that is against current liabilities, means through those current liabilities are created in the books of accounts, and that that liabilities need to be paid by the business firm. Now from where they are going to pay? They are going to pay only when they have in their hand cash in hand and cash at bank and marketable securities, which can be easily sold in the market and get it changed to the form of cash. Now let's discuss the factors affecting the requirement of working capital. Nature of business. Now what business the firm is dealing, whether it's a business of buying and selling, that is wholesaling trade or retailing trade, or the business firm is associated with manufacturing or production of some goods or some commodities. Now if the business firm is associated with trading activities, then the requirement of working capital reduces in comparison to a business firm associated with manufacturing or production of goods. Then scale of operation. If the business scale of operation is higher, then the requirement of working capital is also higher. If the business firm is having opportunities for expanding their business, or you can say if there are growth opportunities, it automatically lead to demand high working capital for the business firm. Now business cycle is another factor which affect the requirement of working capital. Now about business cycle. Business cycle, it is a cycle that is created through the economic activities, and this economic activities, it used to be in different phases, and those phases lead to again the originating phase. Say in a normal level, the business activities, say investment, saving, production, consumption, these are going on, then you can say the market environment is very normal. Now that those economic activities sometimes go down, and that is the phase which is called depression, or you can say recession. Depression is more worse than recession phase, and after depression the economy again go to a recovery phase. Recovery phase, it means the investment activities, consumption activities, production activities again slowly rising, and after the recovery phase it again reached to a prosperity phase, or you can say boom. So in prosperity phase or boom, the opportunities for business firms increased, and therefore there is more investment, more production, more consumption. Now this recession, depression, recovery, and the boom or the prosperity phase, this goes in a cyclical process. If say the economy is at present at a normal stage, then it go to say recession phase, then it go to depression phase, then it goes to recovery phase, and after recovery it reach boom or prosperity phase. So it is like a cycle. Now say in the economy, now the prevailing phase is say the boom or prosperity phase. So in the time of prosperity, the business firms require more working capital. Why? Because at that phase there is more demand in the market, and that's why business firm can undertake more of production activities or more of trading activities, and therefore they need to invest more in their current assets, or they need to keep more stock so that they can easily sell in the market. Then the factor that is seasonal factor affect the requirement of working capital. Say in peak season, the business firm require more working capital in comparison to the slack period when the demand remain low in the market. Then the production cycle, that also affect the requirement of working capital. If there is longer production cycle, that is from raw material conversion to finished goods, what is the time period? If the time period is very long, then the requirement of fixed capital increases. Why? Because an amount of working capital is already blocked in that process. And if the production cycle is shorter, then automatically or in shorter time period, the finished goods, those will be sold in the market, and easily they can unblock the capital that is invested in those and release the money, and therefore the requirement of working capital decreases in shorter production cycle. Then the credit allowed, this is another factor which affect requirement of working capital. Now there are two things, one is credit availed and another is credit allowed. Now credit that is availed by business firm from suppliers, that means there are suppliers who offer raw materials or some other things in credit, and that time they need not block their working capital, so they can invest the money somewhere else for that particular time. And credit facilitated to the customers, now to whom the business firm is selling their products or selling their goods in credit. Now if say the business firm is availing more of credit facilities from suppliers, in that case they can do their business with low working capital. But if they are giving more facility to their customer as credits purchase, then in that case the business firm need to arrange more working capital for them. The operating efficiency of the business firm affect the requirement of working capital. Now what is operating efficiency? Operating efficiency means how best the firm can reduce the expenses in operation. Higher the operating efficiency, lower the requirement of working capital. The availability of raw material is another factor that affect the requirement of working capital. Now larger the lead time, higher the need of working capital. Larger the lead time, higher the need of working capital. Now what is the lead time? Lead time, that is the time period between conversion of raw material to the finished goods, or you can say the lead time right from conversion of raw material till the consumption or till the time when customers can get that particular product or goods in the market. So that is considered as lead time. Now if the lead time is larger, then the requirement of fixed capital is also higher. And if the raw materials are available in the market, then the business firm, they need not keep much of their working capital because raw materials are available all the time. But if the opposite situation prevail, in that time they need to think that let's arrange working capital more and we'll purchase the material in bulk so that there is no hamper in the production process. The level of competition in the market affect the requirement of working capital, and that is very obvious because high competition means higher requirement of working capital. Because if the business firm fail to offer their goods in the market when the competitors are already making available their products in the market, then there is a possibility that this business firm will lose their customer, and therefore they need to keep their working capital sufficient amount and they need to put in production and make the goods available when the demand is there in the market before the competitors make available their goods in the market. Inflation also affect the requirement of working capital. Now you know about inflation. Inflation means rising prices of goods because of decrease in the money value. Higher inflation prevails, higher the requirement of working capital. Now here in the last two slides, I am just briefing the things that I have already discussed. Now in this slide you see when there is requirement of low fixed capital and when there is demand for high fixed capital. Low fixed capital in case of trading organization, when the scale of operation is low, when the labor intensive techniques are used in the business, when there is low rate of obsolescence, when there is low growth prospect for the business firm, when there is low diversification of the business firm, and if the business firm is availing leasing facilities, and if there are some collaborative initiative from the business firm, then they can manage with low fixed capital. And the reverse is true in case of high fixed capital. And in this slide, the low working capital and high working capital, the situations are given. Now say high working capital, in the right side the high working capital is given. High working capital is in case of manufacturing business firm, when the scale of operation is high, when there is high growth prospect for the business firm, when the boom or the prosperity phase of the economy is prevailing, when there is peak season for the business, then if the production cycle is longer, then there is high requirement of fixed working capital. And if the credit allowed to customers is high, then also the requirement of working capital is high. Similarly, if there is high operating efficiency, then this is mistakenly written. If there is high operating efficiency, then they can manage with low working capital. If there is high lead time, then the requirement of working capital is high. If the level of competition is high, then requirement of working capital is high. And if there is high inflation or high inflationary pressure in the economy, then they need to manage high working capital. So with this, I am concluding this tutorial. Thank you.